everyone. Today I'll be presenting Chapter 5 Regulatory Requirements of Risk Management. This chapter explains how financial institutions like banks manage risk under regulatory frameworks, especially the Basel Accords. Let's begin with the regulatory requirements of risk. There are the rules set by regulators to ensure banks manage risk effectively. The purpose is to protect the financial system, depositors, and the economy from instability. Without these rules, risk behavior in banking could easily lead to crises like the 2008 financial crash. Financial stability means the financial system functions efficiently and absorbs economic shocks without collapsing. Regulations are needed to prevent systemic risk which occur when one bank's failure affects others. Regulations promote trust, ensure banks don't take excessive risk, and maintain economic confidence. Banks are structured with assets like loans and securities, and liabilities like customer deposits. The difference between these is their capital. When bank faces risk events like loan defaults or market losses, it reduces their capital. This can lead to insolvency, lower credit supply, and even loss of customer confidence. That's why regulations enforce capital requirements to absorb such losses. To prevent financial crisis, the Basel Committee created a global framework to guide banks in managing risk. The main objectives are to strengthen capital adequacy, supervision, and market discipline. The Basel standards apply to all internationally active banks and ensure they are more resilient to financial shocks. Basel I was introduced in 1988 and focused mainly on credit risk. It required banks to maintain a minimum capital of 8% of their risk-weighted assets. For example, government bonds had a 0% risk weight, while personal loans had 100%. The aim was to standardize risk measurement globally. Basel II, introduced in 2004, expanded the scope of regulation. You can see from the image on this slide that the Basel II framework is based on three pillars, much like a strong building. Pillar 1 is minimum capital requirements. This means banks must set aside capital for three types of risk: credit risk, market risk, and operational risk. Basel II introduced more advanced approaches for calculating this risk. Pillar 2 is the supervisory review process. Here, regulators assess a bank's internal risk management process and can demand additional capital if necessary. Pillar 3 is market discipline. This pillar promotes transparency by requiring banks to publicly disclose their risk exposure, capital levels, and policies. This gives external stakeholders confidence and encourages good governance. Together, these three pillars make Basel II more flexible, more risk sensitive, and more transparent than Basel I. Under Basel II, banks can choose from different approaches to calculate minimum capital. For credit risk, they can use the standardized approach or the internal rating based IRB approaches, either foundation or advanced. For market risk, banks can use either the standardized measurement method or internal models. For operational risk, there's the basic indicator approach, standardized approach, or advanced measurement. The more complex the model, the more accurate, but also the more resources required. After the 2008 global financial crisis, Basel III was introduced to strengthen the system. It raised the quality and quantity of capital banks must hold, especially common equity tier 1 capital. Basel III also introduced two new buffers: the capital conservation buffer of 2.5% on the counter-cyclical buffer, which increases during boom times. It also added liquidity coverage ratio LCR and net stable funding ratio NSFR to ensure banks can survive liquidity shocks. Additionally, it introduces leverage ratio to limit over borrowing. Basel IV, although considered an extension of Basel III, aims to improve risk sensitivity and consistency. Effective from 2023, it changes how banks calculate risk weighted assets. It sets an output floor, meaning banks can't report risk weighted assets below 72.5% of what the standardized approach would show. This reduces manipulation of internal models. It also revises the standardized approach for credit and operational risk and aims to improve comparability across banks globally. To summarize, Basel I introduced credit risk and a minimum capital ratio. Basel II added operational and market risk with three strong pillars. Basel III reported the financial crisis with stronger capital and liquidity standards, and Basel IV focuses on accuracy and consistency in risk calculations. Altogether, the Basel's framework makes the global banking system more secure, stable, and transparent. Thank you.
Hi, my name is Priyaroshni Lagunathan and my metric number is F1010. Today I will be covering 6 key aspects of risk management and governance, specifically capital adequacy and corporate governance. Let's start with how capital adequacy rules apply to Islamic banks. Islamic banks, like all banks, must ensure they have enough capital to absorb risk and losses. However, because Islamic banks operate under Sharia principles, they offer unique contracts like Mudarabah, Murabaha, and Ijaza, which is differ from conventional loans. To guide Islamic banks, the Islamic Financial Services Board, also known as IFSB, provides standards that adapt the Basel Framework to Islamic finance. Capital must cover a wide range of risk, including credit risk, market risk, operational risk, and importantly, Sharia non-compliance risk. For example, in a Mudaraba account where profits and losses are shared, the bank faces both credit and equity investment risk. So capital buffers must be adequate. Next is the large exposure risk requirement for Malaysian banks. This requirement limits how much a bank can lend or expose itself to a single borrower or a group of connected borrowers. The goal is to reduce concentration risk, means the risk that failure of one large borrower could harm the bank severely. In Malaysia, Bank Negara Malaysia, also known as BNM, keeps this at 25% of the bank's capital base. Bank must report large exposure and ensure proper risk management, such as requiring additional collateral or diversifications of their lending portfolio. Moving to next slide, operation of saving and investment account. A conventional saving account is familiar to most of us. It earns interest, has low risk, offers liquidity, and also the principal is protected by deposit insurance. In contrast, Islamic investment accounts are based on profit sharing contracts such as mudaraba or wakala. Depositors share in profits and may share in loss. Returns are not fixed and the principal is not guaranteed. This introduces higher risk but also potential for higher returns. And the alliance with Islamic finance principle of risk sharing and prohibition of interest. Now let's move to corporate governance. Start with the nature of corporate governance and its relevance in Malaysia. Okay, the corporate governance refer to a systems, rules and process used to control and direct a company. In financial institutions, strong governance is crucial because banks handle public funds and affect economic stability. In Malaysia, corporate governance ensures that accountability, protects depositors and investors, ensure transparency in decision making, and also promotes compliance with laws and regulations. Good governance builds public trust and reduces the risk of fraud or financial mismanagement. Next is the Malaysian Code on Corporate Governance, which is called as MCCG. Okay, the MCCG is issued by the Securities Commission Malaysia, sets guidelines for how companies, including financial institutions, should be governed. So the key features are included like a balanced board with independent directors, clear division of responsibility between board and management, strong risk management and internal control systems, timely and accurate disclosure of financial and operational information, respect and protection of shareholders and stakeholders' rights. So the MCCG is regularly updated to align with global best practice, strengthening Malaysia's corporate governance landscape. Okay, lastly, principle of corporate governance. There are 6 main principles. First, accountability. Boards and management are accountable to shareholders and stakeholders. Next is transparency, accurate, timely, and disclosure of relevant information. Third is fairness, equal treatment of all shareholders, including minorities. Fourth point is responsibility, clear duties, risk management also, and regularity of compliance. And the next point is integrity and ethical conduct, acting in the best interest of the company and stakeholders. And the last point is sustainability, long-term value creating, considering environmental, social, and governance, also known as ESG factors. In conclusion, understanding capital adequacy and corporate governance and how they apply in Malaysia and Islamic finance is critical to maintaining a sound, stable financial system. Thank you.